Welcome to the Candlestick series. In this part 3 we will discuss on the multiple candle patterns. Morning and evening star. The morning star pattern is a bullish reversal candlestick formation that typically appears at the bottom of a downtrend, signaling a potential trend change from bearish to bullish. It consists of 3 candles. First, a long bearish red candle that continues the existing downtrend, indicating strong selling pressure. Second one is a small-bodied candle or doji that gaps down from the first candle, reflecting market indecision and a pause in the downtrend. Third one is a long bullish green candle that gaps up from the second candle, closing above the midpoint of the first candle, which confirms the reversal and indicates renewed buying pressure. The evening star is exactly opposite of morning star in direction. First, a long bullish green candle that continues the existing uptrend, indicating strong buying pressure. Second one is a small-bodied candle or doji that gaps up from the first candle, reflecting market indecision and a pause in the uptrend. Third one is a long bearish red candle that gaps down from the second candle, closing below the midpoint of the first candle, which confirms the reversal and indicates renewed selling pressure. Volume confirmation. For the star patterns to be considered valid, it is often recommended to look for increasing volume throughout the formation, especially on the third candle. High volume on the third day is seen as a confirmation of the reversal. Belt hold pattern. This is a reversal candlestick pattern, only difference is here is a gap following the first candle. The bullish belt hold candle, similar in appearance to a green Maribozu, opens at the low of the period and subsequently rallies to close near its high, leaving a small shadow at the top of the candle. The pattern surfaces after a stretch of bearish candlesticks in a downtrend. The candle's opening price is significantly lower than the previous day's low. The pattern closes well into the body of the previous candle, holding price from falling further, hence the name belt hold. The bearish belt hold is a candlestick pattern that occurs during an upward trend. It is characterized by a tall red candlestick with the opening price higher than the close of the previous day and then close lower. This pattern signals a potential trend reversal from bullish to bearish. Separating lines. The separating lines candlestick pattern is a 2-bar formation that signals trend continuation. Bullish separating lines. This occurs during an uptrend, when a long bearish candle is followed by a long bullish candle that opens at the same price as the previous candle's close, indicating a continuation upward trend. Bearish separating lines. This pattern is the opposite, where during a downtrend a long bullish candle is followed by a long bearish candle that opens at the same price as the previous candle's close, suggesting a potential downward trend. Characteristics. The pattern is recognized for its 2 distinct candles, and it is classified as a continuation pattern, meaning it often indicates that the current trend will continue. 3 white soldiers and 3 black crows. 3 white soldiers is a bullish candlestick pattern that is used to predict the reversal of the current downtrend in a chart. The pattern consists of 3 consecutive long-bodied green or bullish candles that open within the previous candle's real body, and closing exceeds the previous candle's high. 3 black crow is opposite of the earlier pattern. It is a bearish formation that is used to predict the reversal of the uptrend in a chart. It consists of 3 consecutive long-bodied red or bearish candlesticks that open within the previous candle's real body, and closing exceeds the previous candle's low. Characteristics. It consists of 3 long-bodied candlesticks that close progressive in same direction. Each candle should open within the body of the previous candle, which shows that the momentum is continuing. Ideally, these candles should have little to no lower shadows, suggesting that bulls or bear are in control throughout the trading session. Increased trading volume accompanying the pattern can provide additional confirmation of the reversal. Rising and falling 3 method. Rising 3 methods is a bullish continuation candlestick pattern that typically forms during an uptrend. It consists of 5 candles. The first one is a strong bullish candle Then next 3 candles are small bearish candles, those are contained within the range of the first bullish candle. Then final candle is a strong bullish candle that closes above the high of the first candle. This pattern indicates a temporary retracement in the price before the uptrend resumes, suggesting that buyers are still in control. Falling 3 methods is a bearish continuation candlestick pattern that signals a potential resumption of a downtrend after a brief counter-trend movement. First candle is a long bearish candlestick that indicates strong selling pressure. Middle 3 smaller bullish candlesticks represent a temporary retracement or consolidation against the prevailing downtrend. These candles should remain within the range of the first bearish candle. Then last one is a long bearish candlestick that closes below the first candle's close, confirming the continuation of the downtrend. Mat hold pattern. It is a 5-candle continuation pattern, which looks similar like rising and falling 3 methods. This pattern shows a trend taking a short pause before resuming. The bullish mat hold starts with a strong green impulse candle in the direction of the existing trend, followed by 3 smaller red candles that form a tight consolidation. Then final candle breaks out in the same direction as the first with another green close, confirming that momentum remains intact and the trend continues. The bearish mat hold starts with a strong red impulse candle in the direction of the existing trend, followed by 3 smaller green candles that form a tight consolidation. Then final candle breaks down in the same direction as the first one with another red close, confirming that momentum remains intact and the trend continues. Tweezer bottom and top. A tweezer bottom pattern is a bullish reversal candlestick pattern that occurs at the bottom of an downtrend, indicating a potential price rise. This pattern consists of 2 candlesticks that have approximately equal lows. The first candlestick is typically bearish, while the second is bullish. A tweezer top pattern is a bearish reversal candlestick pattern that occurs at the peak of an uptrend. This pattern consists of 2 candlesticks that have approximately equal highs. The first candlestick is typically bullish, while the second one is bearish. Tweezer top or bottom pattern is a valuable tool for traders looking to identify potential reversals of a trend. 3 stars in south and north. The 3 stars in the south is classified as a 3-line bullish reversal pattern. All its candles are getting shorter and having bearish red bodies, what indicates that a bearish momentum is weakening. The first candle having a long lower wick. The second candle opens below the prior opening price and closes below the prior closing price. The third line is a Marubozu candle having a red body. This pattern shows the exhaustion of current bearish trend and reversal is emerging. 3 stars in the north is bearish reversal pattern. All its candles are getting shorter and having bullish green bodies, what indicates that a bullish momentum is weakening. The first candle having a long lower wick. The second candle opens above the prior opening price and closes above the prior closing price. The third line is a Marubozu candle having a green body. This pattern shows the exhaustion of current bullish trend and reversal is emerging. This pattern also comes with dojis, which names as bullish or bearish 3 stars or tri-star candlestick patterns. These also functions the same way. Bullish and bearish breakaway, it's a reversal pattern. The bullish breakaway pattern is a 5-bar pattern. This first bar is long and bearish, showing the market sentiment as largely bearish. The bearish sentiment prevails in the form of the next 3 candlesticks, although they are smaller. This is indicative of the bears losing the battle or the bearish trend is getting weaker. The final reversal comes in the last bar, which pushes through the trend of the last 3 bars and breaks away. It turns bullish and indicates the reversal. The bearish breakaway pattern is just opposite one. Here the first bar is long and bullish. That bullishness prevails in the next 3 candlesticks, although they are smaller, showing bulls are losing control and the trend is getting weaker. The final reversal comes in the last bar, which pushes through the trend of the last 3 bars and breaks away downward with a strong bearish candle and indicates the reversal. Bullish and bearish ladder. The ladder pattern is a 5-candle reversal pattern. The bullish ladder starts with 3 consecutive long red candles. These candles have successive lower opens and close, resembling the 3 black crows formation. Then the 4th candle is a short-bodied red candle with a long upper wick like inverted hammer. Then comes the 5th, which is a large green candle that opens above the close of the 4th candle, then goes further higher, and showing reversal of the trend. The bearish ladder starts with 3 consecutive long green candles. These candles have successive higher opens and close, resembling the 3 white soldiers formation. Then the 4th candle is a short-bodied green candle, with a long lower wick like hanging man. Then comes the 5th, which is a large red candle that opens below the close of the 4th candle, then goes further lower, and showing reversal of the trend. Upside and downside Tasuki gap. The Tasuki gap pattern is a candlestick formation used in technical analysis to indicate a potential continuation of a market trend. Upside Tasuki gap pattern consists of 3 bars, 2 bullish candlesticks followed by a bearish candlestick, with a gap up between the first 2 bars and the third. It signals that the market's bullish trend will continue. Downside Tasuki gap. This pattern consists of 3 bars, 2 bearish candlesticks followed by a bullish candlestick, with a gap up between the first 2 bars and the third. It signals that the market's bearish trend will continue. All these patterns can help us to understand trend within the chart. It's recommended to check other indicators and volume as confirmation to help in trades. If this video helped you to learn something new, please like, share, and subscribe the channel. Thank you.